So today I want to talk about Japan's bond market turmoil, why it's happening and why it matters globally. Now, Japan's government bond market, which is long known for rock bottom yields and stability, is suddenly in turmoil. Long-term Japanese bond yields have surged to levels unseen in decades, catching many investors off guard. Now, this spike is eroding the value of existing bonds and saddling institutions with losses while raising questions about Japan's fiscal health. Now, the effects aren't confined to Japan shores. What happens in Tokyo's bond market is rippling through global finance, from the US Treasury market to the portfolios of everyday investors. So first of all, let's go and understand this particular matter. Why are Japan bond yields soaring? Now, after years of ultra low, even negative interest rates, Japan's long-term government bond yields have shot up dramatically. Now, in recent weeks, yields of 20-year, 30 years, and 40-year Japanese government bonds, or better known as JGBs, jumped to record highs. Okay. Now, an example is the 30-year JGB yield spiked above 3.1%, an all-time high since bond yields inception, and the 40-year yield hit about 3.6%, also a record. Now, just for those that are not familiar with bonds, yields move inversely to bond prices. So these rising yields means bond prices are falling. Such levels are astonishing in a country where 30-year yields were below 1% not long ago. Now, there are several forces behind this spike in yields. Japan is confronting a sharp shift in its financial landscape. After decades of deflation and low inflation, core consumer prices surged 3.5% in April, far exceeding the Bank of Japan's 2% target. This rise in inflation reduces the real value of fixed income assets, prompting investors to demand higher yields. As a result, pressure is mounting on the Bank of Japan to either tighten monetary policy or long-term interest rates to rise, or allow long-term interest rates to rise. Now, compounding this is Japan's severe fiscal position. With public debt exceeding 260% of GDP, the highest in developed world, even Prime Minister Kishida has publicly admitted that Japan's finances are in worse shape than Greece, casting doubt on the long-term sustainability of the government's borrowing. Now, worst of all, recent bond auctions have shown weak investor demand, notably a poor 20-year Japanese government bond auction with the lowest bid to cover ratio in over a decade. Now, this signals that investors aren't willing to absorb new issuance unless yields rise significantly. They are demanding more protection, indicating market is wary of holding too much Japanese debt at current levels. Okay. Now, adding to market unease is a major shift in BOJ's policy. The BOJ has long acted as the primary buyer of the Japanese bonds under its yield curve control policy, capping long-term yields. However, it has begun to taper its bond purchases, particularly the super long maturities. They are maintaining the short one and the 10-year, but above 10-year, like a 20-year, 30-year, 40-year, they just let it, you know, uh, it's effectively withdrawing its role as the buyer of the last resort, and let the market decide what the yield should be. And this has triggered a sharp rise in long-term yields as private investors test where equilibrium lies in the market without full Bank of Japan support. Okay, so Japanese bond market turmoil is rippling across banks, insurers, and the economy as well. The recent surge in JGB yields is having far-fetched consequences for domestic financial system, particularly for institutions heavily invested in long-term bonds. An example is the life insurer like Nippon Life have suffered major unrealized losses, with 3.6 trillion yen, which is approximately 25 billion US dollars reported, and are reducing their bond purchases. Other insurers such as Sony Life are also cutting exposures to super long bond. Major banks like Norinchukin are cautious as falling bond prices threaten their capital buffers. The Japanese yen has become volatile. Higher yields attract money back to Japan, but fiscal concerns and fears of debt monetization weighs on investor confidence. The finance ministry is preparing to intervene if needed, supported by large foreign exchange reserve and US Treasury holdings. Okay. Higher yields are also raising borrowing costs across Japan. The government is now paying over 3% on long-term bonds, which tightens fiscal space and could slow economic growth. Businesses and banks may face increased costs as well, especially in interest-sensitive sectors. Okay, just give you example what the interest-sensitive sectors those are like the real estate. Okay, the real estate businesses, they are interest-sensitive sectors as well as the tax as well. Okay, as the tax. Now, this bond market turmoil has begun to affect equities. The Bank of Japan is trying to normalize policy gradually, but may need to step back in to prevent broader fiscal instability if volatility persists. Okay, so far, how the Japan bond market is shaking up the market. So first, let's just look at the impact on the US stock market. Number one is capital flight risk. For a decade, Japanese institutions were major buyers of US assets, especially treasuries and blue chip equities due to near zero domestic yields. Now, with JGBs offering 3 to 3.6% returns domestically, there's reduced incentive to hold US securities. They might not look into the US since, you know, the Japan is also returning this kind of returns as well. There's this possibility. Now, this could cause potential capital repatriation from US markets to Japan. Okay, that means they're selling the US dollars and buying the Japanese yen. It also reduces demand for US equities and treasuries, right? And last, institution may sell US stocks or ETF to cover domestic bond losses or rebalance portfolios. This is what we call as capital flight risk. Other than that, we have the rising US Treasury yields. Now, if Japan sells more US Treasury to raise cash for fiscal needs or yen defense, US bond prices will fall and yield will rise in the US. Okay. Now, just to let you know, Japan is one of the largest holders of US bonds. Okay. So when they start selling, the yields or the interest will rise, and rising yields are negative signals for US equities, especially tech stocks and other high duration assets that rely on low interest rates for valuation. Okay. Next, there's also the risk sentiment. Increased volatility in Japan may ripple into global risk sentiment. If Japan's bond market becomes unstable, investors might go risk off, reducing equity exposure globally, including the US. Now, historically, during periods of Japanese yen volatility or sudden BOJ surprises, US equities have seen short-term corrections due to correlated risk unwinding. Okay. Next, what's the impact on the US dollar? Less demand from Japan for US dollar as US dollar denominated assets. Japan is the largest foreign holder, like I mentioned, of US treasuries, which is 1.13 trillion, a continuation of recent trend. Example, the 119.3 billion in US treasury sell-off in one quarter that we have seen would reduce Japan's US dollar denominated holdings. This would result in a decrease in demand for US denominated assets, which then softens US dollar over time. Next, we have the US fiscal pressures echoing Japan. Investors are also growing skeptical of US fiscal health. Treasury auctions are weakening and deficits remain at 6.4% of GDP. Moody's recently downgraded US debt, as you all know, right? So if Japanese sales amplify existing US fiscal doubts, US dollars could weaken as markets question long-term debt sustainability. Okay. And then there's also the forex hedge adjustments. If Japanese investors exit US dollar denominated bonds, they may unwind currency hedges impacting forex markets. Some hedge positions may be reversed, putting additional selling pressure on US dollars in the medium term. And what about the impact on the Japanese yen? First of all, we would see a stronger yen from yield repricing. As the Japanese bond yield rise, yen-denominated assets become more attractive. This naturally increases demand for yen, leading to appreciation. There's also this case of carry trades unwinding, which is investors who borrowed yen to buy foreign assets are reversing positions. And also there's a possible intervention as well. The Japanese government has historically intervened to support the yen during rapid depreciation. But now, with rising domestic yields, the Bank of Japan may be less inclined to act, especially if the yen is appreciating. And the Bank of Japan may sell US Treasuries to defend the yen, which also feeds back into the US dollar weakness and US market stress. Okay. And finally, expect some volatility. The market is unsure how far the Japanese bond yields will climb or whether the Bank of Japan will step in. That uncertainty leads to yen volatility with large swing depending on policy announcement, bond auctions, or global rate shifts. So as a conclusion, what's to watch? First of all, upcoming Japanese bond auctions. If demand stays weak, it may signal deeper instability. Okay, we are referring mainly to the longer term bonds. Okay, now next is the Bank of Japan policy moves. A return to yield curve control. That means they're buying back the bonds again to control the yield, or rate cuts would change the yen outlook. Because all this while we are thinking about yen not cutting, but what? But the raising its interest rates. But if it changes that thing, the whole idea, the yen outlook will change. But for now, nothing yet. So let's wait. The US Treasury Holdings was Japan's monthly Treasury international capital data for signs of off-leading US assets. This you can go to the US Treasury website and to look at it. Okay, so the next quarter, if we see any more selling by Japan, it also signals something is happening behind, and for us to prepare in advance based on just now what I shared with you, the impact on the yen, on the US dollars and the US stock market, right? And finally, yen movements, sustained strength could signal a global rotation out of US equities and risk assets as well. Okay, so hopefully this sharing is able to give you an idea overall how this Japanese bonds are related to the US market and subsequently the whole world. Okay, with that, that's the report for today.